To the Q3FY23 earnings conference call of PI Industries Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star and then 0 on your touchtone telephone. I now hand the conference over to Mr. Nishit Solanki from CDR India. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone, and thank you for joining us on PI Industries Q3FY23 earnings conference call. Today, we are joined by senior members of the management team, including Mr. Mayank Singhal, Executive Vice Chairman and Managing Director, Mr. Rajnish Sarna, Joint Managing Director, Mr. Manikantan Vishwanathan, Chief Financial Officer, Mr. Prashant Hegde, CEO Domestic, and Mr. Atul Gupta, CEO Export. We will begin the call with key perspectives from Mr. Singhal. After that, we will have Mr. Manikantan sharing views on the financial performance of the company. After that, the forum will be open for question and answer session. Before we begin, I would like to underline that certain statements made on today's conference call could be forward-looking in nature, and a disclaimer to this effect has been included in the investor presentation shared with you earlier, and is also available on Stock Exchange website. I would now like to request Mr. Singhal to share his perspectives. Thank you, and over to you, sir.
Good afternoon. Good afternoon, everyone. Thank you for being with us today on this call to discuss the third quarter performance. It gives me immense pleasure to share that PI has delivered another quarter of our performance. Year on year, our revenue growth during Q3 came at 19% with an EBITDA increase of 40% and a margin standing at 26%, supported by favorable product mix and operating leverage. Consequently, our profit during the Q3 saw an expansion of 58%. Further efficient net working capital management has been a significant improvement in free cash flow. In line with the superior performance, the Board of Directors has considered an interim dividend of 4.5 rupees per share for 22-23. Our branded products for crop, including cotton, rice, horticulture, and row crops, has performed well. With a portfolio of advanced brands, we have carved out a leadership in the respective categories. Further, we are recording attractive responses to the spate of new brands that we have recently introduced in the domestic market. One of the highest number of launches in the industry, our branded integrated incorporated resistant category solutions for crop protection helping farmers prosper. We have a strong solution for crop protection. Our pipeline of products of different stages of development to continually enhance our portfolio. The institutional sales remained subdued during the quarter due to higher channel inventory and reflected in the overall domestic revenue growth. Further, we have improved efficiencies and increased realization and reduced working capital for the branded business. Dynamics within the global specialty chemicals are evolving to realize higher value proposition for products from India, where we as a company stand both in terms of quality, process and technology. Global clients are prioritizing diversification of source of India, and even as the country develops to integrate value chain, the key chemistries, our order book position for the end of the quarter stood at around 1.8 billion, indicating the confidence of the innovative response to our business and model of delivery with well-established credentials. We are renowned for its ability to partner with innovators at the global requirements. PI has entered niche and through proactive investments in capacity building and research in novel technologies and platforms. This needs for breakthrough innovations today is very important, and technology will need to be scaled up more effectively and efficiently. Our ability to engage at a global level on long-term relationships basis our team of understanding complex chemistries and core advantages with companies and partners across the globe. The share of non-agchem inquiries continue to grow. Commensurate that, we are also enhancing our capacities in the non-agchem space. We have augmented our look and widening customer relationships deeper. Our research and innovation teams are continuously engaged in developing new generation offerings. We comfortably placed to realize 20+% growth. We will be backed by expansion in the business from commercialized molecules with better margin portfolios. Sharper checks on costs. Recently launched molecules continue to scale up and will continue to contribute strategically in the next few years. We aim to commercialize 4 to 5 molecules every year and to leverage the momentum and set capacity expansion further in the coming year. I'm happy to say we have commercialized new products with a high potential of growth into the future. The model remains poised to scale up markedly on consumption of new pharma entity takes shape. We continue to actively evaluate inorganic growth opportunities in pharma, domestically and internationally, in line with our pharma strategy. Initiatives to augment leadership are ongoing and continue to stir our foray into this space. I am pleased to report, and in a pride moment for PI, we received the Golden Peacock Award for Sustainability for Corporate Social Responsibility for the year 22. PI is committed to inclusive growth, aligning with the SDGs, and creating long-term sustainable solutions towards reimagining a healthier planet. And with this, may I draw the opening remarks to a close and hand it over to our CEO, Mr. Manikantan, for the financial discussions. Thank you once again to all of you for joining this call.
Thank you, Mr. Singhal. Good afternoon, everyone, and thank you for joining us on the call today. I will summarize the company's financial highlights for the third quarter ended 31st December 2022. Please note that all comparisons are on a year-on-year basis and refer to consolidated performance of the company. During Q3 FY23, we reported revenue of 16,132 million, a growth of 19% over the same period last year. This was driven by growth in export revenues by 23% to 13,286 million and 2% increase in domestic revenues to rupees 2,846 million. Export revenues growth of 23% was driven by volume growth of around 9% and price and currency of around 14%. New innovative agri brands launched recently also contributed to our growth. Our gross margin increased by 73 basis points to 47%, partially due to cost pass-through and favorable product mix. EBITDA increased by 40% to rupees 4,156 million for the quarter, driven by operating leverage benefits and tight control on fixed overheads. Profit after tax increased by 58% to rupees 3,518 million, attributable to EBITDA growth. Cash flow from operating activities during 9-month period was 9,951 million. This was due to higher EBITDA and efficient management of net working capital. The trade working capital in terms of number of days of sales was reduced to 90 days, because it's 103 days as of March 31st, 22. Our balance sheet further strengthened during the quarter. Net worth increased to rupees 69,716 million. The capex for 9-month period stood at rupees 2,585 million and is in line with our plan. This year, we estimate the capex of around 5,000 million. Inventory levels reduced in terms of days of sales to approximately 81 days to rupees 14,517 million, still serving higher revenue and adequate safety stock to our supply chain disruptions. The company maintained a strong liquidity position and has recently repaid outstanding ECB loan of $25.71 million. That concludes my opening commentary. I will now request the moderator to open the forum for question and answer. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may enter star and 1 on their touchtone telephone. If you wish to remove yourself from a question queue, you may press star and 2. Participants are requested to use handsets while asking a question. We would also request you to please limit your questions to 2 per participant. Time permitting, you may come back in the queue for a follow-up question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Abhijit Akela from Kotak Securities. Please go ahead.
Yeah, good afternoon, sir. Thanks a lot for taking my questions. 2 of them. First, on the capex side, the presentation talks about planning to intensify the capex, in the future. So while we are guiding to about 500 crores of capex for fiscal 23, Is there a number you could help us out with for 24? Is it going to be substantially larger, and if so, on which projects? And the second part was just on the pharma side. I believe we've invested 675 million into PI Health Sciences to kickstart our organic initiatives on the pharma side. If you could please just elaborate a little bit about the plans out there. Thank you.
Thanks, Abhijit. So for the first question, this year we had a plan of 600 crore capex, but some part of it will surely get rolled over as some of the multi-product plants we are reworking on the design as some of the products have progressed well on commercialization, and we are redesigning some of these things. But for next year, we are, as we mentioned in our presentation, we are expecting anywhere around 800 to 850 odd crores of total capex in the next financial year.
Got it, sir. And also, if you could just talk about the pharma investment into PI Health Sciences.
Yes. So about the pharma investment, this investment is basically for initial operating setup and our activities that we are intensifying and augmenting our resources in the pharma space. And this is where towards this objective we have capitalized this our new organization to start these activities.
Fine. And just the last thing from my side was on the margins. Margins overall have been, much stronger than perhaps we would have expected, about 25.7% this quarter. So any, specific benefits this quarter in particular, or is this a sustainable sort of run rate for the future?
Well, this is majorly coming from 2-3 areas. One is that the product mix has been positive for us in this quarter. Secondly, the sheer operating leverage benefit is also kicking in because with this sustained 20-25% kind of growth, these operating leverage is certainly kicking in. And then, of course, we have had a very tight control on our fixed costs. So all these are contributing to this margin level, and we are expecting this to, while there will be certainly some variation quarter-on-quarter basis depending on the product mix, but on a year-on-year basis, I think we'll be able to reasonably sustain these margin levels.
Thank you so much, sir. I'll join back the queue for more.
Thank you. Our next question is from the line of Vivek Rajamani from Morgan Stanley. Please go ahead.
Good afternoon, sir. Thank you for taking my questions. 2 questions from my side. Firstly, there's obviously been some concerns of slowdown in some pockets of agrochemicals, both domestically and within the export market. Could you maybe provide some color on the trends that you're seeing with respect to your products, both for domestic and exports? That was the first question. And secondly, on your point where you're saying you'll obviously be focusing more on capacity expansions going into next year, any indication on what kind of increase you're envisioning there? I know that this is not a straightforward question with respect to your products, but some color would be very helpful. Thank you so much.
So if I get your first question right, you're saying there's a downward trend for agrochemical products, or what was that? I didn't get that clear.
Some trends that you're seeing with respect to your products, sir.
Okay. So if I look at the product portfolio, I think that's the unique part about PI. Both the domestic business, as you've seen, we have declared that we've done one of the highest launches of innovative products. And clearly, these innovative products have so much growth trajectory, while the growth has been muted, and that's been purely driven by efficiencies and driving and ensuring that we're not overstacked up. But new products will continue to grow, and we see a good positive trajectory coming from the product portfolio that we have. And we just sown seeds for 5 to 6 brand new products in domestic business. I'm pretty sure some of them will scale up to a different rate height. Obviously, favorable weather conditions will give us some exceptional outcomes. When I look at the global product portfolio that we are in, we again see positive trends. Some of the large products that we are in still need to be still need to be registered globally, and there is a positive trajectory of growth continuing to happen. At the same time, we've entered some interesting strategic products which have good huge potential of growth in the global markets, and that's quite exciting us to see that we are poised to be in a comfortable position in terms of our product portfolio strategy. While there could be certain headwinds which could come in, but easily these will be pretty ones, the stronger ones, which will take good shape into the future.
Thank you, sir. So just to clarify, you've not really seen any significant slowdown with respect to your products, particularly on the export side. Would that be a fair statement?
Yes, I think I can say that because we already, as you know, we have put in all of the position we see for responsive demand and that continues to happen. So that's where we are right now.
Sure, sir. And on the capex, on the capacity expansion, any color would be really helpful. Thank you.
I think that was answered. Obviously, one big job has been done. We've looked at about taking 12% plus capacity from the existing assets by looking at various engineering and technological solutions, which is further reduced and given us the growth trajectory that we have, and which has been postponed into new product mixes that we have to happen in the CapEx going into the next year, as mentioned earlier. And looking at the pipeline and potential of the new platforms and technologies, we are looking at a total outlay of 600 plus crore extra CapEx for next year, and then we are following through a certain flow of CapEx in this current year. So that's where we are.
Got it, sir. All the best.
Thank you. Our next question is from the line of Aditya Jhawar from Investec. Please go ahead.
Yeah, thanks for the opportunity. So my first question is, so one of our key molecule has seen a very strong growth in this quarter. So just wanted to understand that, what could be the reason driving this growth? Are you seeing, market, a wider application of this product? Are farmers using this product as a substitute of glyphosate? Because I'm sure you would have also collected some market intelligence on what should be the growth for one of our, key products.
Well, as you know, these products are cyclical in demand, so it's not that the consistency is throughout. One, yes, and when you look at the second part of the question, there has been product portfolio expansion with companies, global companies who are partners to expand in this product worldwide, from what we understand. Geographies which are being added, clearly application and acceptance is growing, so we see a positive trajectory coming through this. And that has given us this growth, and obviously, I would not like to from which quarter up and which quarter down. It depends on supply chain, market situation, crop positioning, which is taking place in various part of the geographies.
Okay, that's good to hear. So that essentially means that the growth that we have seen is a organic growth, and it is not that the inventory get filled up in the channel, and in the subsequent quarter we see a significant slowdown. Yeah. My next question is on the tax rate side. What should we expect on a tax rate on a full year basis?
The tax rate will be around the current quarter is 14 for 9 months is 14.5%. So the full year basis will be less than 15%, round about.
Sorry, less than 15%.
Yeah.
Okay. Yeah, I'll fall back in queue. Thank you.
Thank you. Our next question is from the line of Rohit Nagraj from Centrum Broking. Please go ahead.
Yeah, thanks for the opportunity and congrats on a good set of numbers. So first question is on slide number 9. We have mentioned that more than 60% products falling in green category. So what exactly does this mean, and how beneficial it is for us, given that the sustainability is a criteria for global innovators? Thank you.
Yes. So, the product falling under the green category means, the waste which is generated per kg of the product, and there is an international guideline basis which it is decided that which product fall in green category, yellow category, and then red category. So it is this international criteria which we have applied to our products, taken them on priority, and then worked on systematically in development stage to reduce the waste. So that's how we say that this falls in the green category.
Right. Just a clarification, this is applicable for both CSM as well as domestic?
Yes, it is for both.
Right. Got it. So second question is, after commercializing 3 products in CSM, what is the total number of products in CSM and any non-agro products in current basket? And for next year, are there any non-agro products which will be commercialized in FY24? Thank you.
Yeah, so we have already got 4 commercial products in the non-CSM scale. We are looking to commercialize 2 to 3 in the next year. And obviously, we are in the early stages of this business, still not formally substantial part of the revenue, but these are investments which are showing us positive direction for growth and customer confidence building.
Thank you. Just total number right now, including these 4 products?
We would not have a number on hand and for the moment.
Sure. Thank you so much for that.
Thank you. Our next question is from the line of Vishnu Kumar AS from Avendus Spark. Please go ahead.
Thanks for your time and congrats for good numbers. So this question is on margins. In the past, we understood that many of our contractual terms with the customers are that we will earn a fixed kilo per margin. And so irrespective of the price movements, we'll earn a fixed price, and higher pricing will still probably, the percentage margins will be lower. That is one. And second, as the production scales up for certain products, we were, at least what we understood was that we will have to transmit certain efficiency gains to the customer. But the current commentary seems to suggest that there is a change in the contractual terms. If you could slightly elaborate on this point.
Yeah, so you see, this is, as I explained earlier, this is majorly coming from change in product mix favorably for us. Every year we are launching 4 or 5 products. Even in domestic, many new products have been added in last 2-3 years. So obviously, the product mix is favorably changing. That is one. And secondly, the operating leverage benefit. So the understanding generally that we have with our customers, and this is where, because we suffer in the initial periods with the lesser utilization of these plant investments and all, at a later stage when the operating leverage kicks in, that balances, the earlier lower margin. So right now, at this stage, some of these benefits are kicking in, and that is giving this reflection.
Understood. Sir, in terms of new products on the export side, how much would be, let's say, the last 2-3 years, if we have launched certain products, any rough contribution of revenue, if you could just help us understand? Last 2 years or 3 years, what would that proportion of your overall revenue would be?
Well, we don't have these numbers or tips, but I think, as I mentioned, in last call, some 17-18% is around that comes from products introduced in last few years.
Got it, sir. And since on your comment, you said that domestic products also we are getting better margins. So the margins that you're currently earning would be higher in the domestic because of the new product launches. Is that the way also we can think? That you are earning slightly better numbers from the domestic?
Creating new products and new margins, the domestic business will be giving us the contribution level, we know that.
Got it, sir. And just on the capex bit, you said we have spent about 250 out of the 600. Another 350 is pending, plus about 800, which you just mentioned. When should we expect these new plants to be coming up? Any rough commissioning dates that we are looking for?
Yeah, so just to clarify on it, as I mentioned, that some of the capex which was planned in the current year is getting rolled over because of the plant design related and implementation related development. And that will also get covered under this 800 odd crore that we are indicating. Okay, so this includes that rollover also, not that 800 plus whatever 500, 400 that we have been talking. We have 2 multi-product plants scheduled to get commissioned, maybe one at a later phase or second half of next year, and the other one also we are monitoring, but that may go to next year, which is FY25. So this is currently the plan, tentative plan that we have.
And on the other hand, we change the way the structural formats of how we look at these plants from the technological capability, hence giving us better throughputs and efficiencies with the larger footprint for each plant.
Got it, sir. And sorry, I'm just circling back on the margin. Should we take the guidance to be probably at 23-24% from here on? Earlier it used to be 21-22. So should we see a step up going forward over the next couple of years to be anywhere between 23-24, or any thoughts?
Yeah, 23-24% is what currently we are estimating.
Okay, sir. Thank you. All the best.
Thank you. Next question is from the line of Ankur Periwal from Axis Capital. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity and congrats for a good set of numbers. Sorry, again, just checking on the capex side. So on the, our earlier commentary was that we will be continuously focusing on improvising and improving the asset turns, which we have sort of, displayed over the last few quarters. And at the same time, the capex number is also getting increased. You also, suggested to invest further into the pharma, production there, for pharma products there. So, is there, from your thoughts perspective, from a sustainable growth run rate in CSM business, are we looking at upwards of 25% plus, or maybe even higher, rather than the 20% plus mark that you typically comment on?
No, in terms of growth, we are still sticking to 20% plus growth rate on a sustainable basis. That's what currently we are predicting, and we are continuing with that guideline.
Sure. Where I was coming from was, typically it takes 3 to 4 years for a product to mature, and historically we had launched, newer products, which were probably margin negative as well as, higher potential ones. So is there a faster growth coming in the near term there, or probably it's still a medium term thought?
No, while yes, product takes 3-4 years for maturity, but we have to also appreciate that the base is also growing. If you see last 2, 3, 4 years of growth, we have been 25% plus kind of growth year on year. So the base is also growing, and therefore we are guiding for 20% plus kind of growth rate on a sustainable basis. Although there are opportunities, but this is where we are a bit cautious in guiding on growth.
Sure, sir. And just second bit on the domestic side. One, if you can comment how the branded or the newer launch products are doing in terms of growth rate versus the slightly older portfolio. And secondly, your comment on the channel inventory. Is it largely done, or probably it will take some more quarters to settle?
Yeah. So, as you rightly said, yes, the channel inventory, because of lower than expected uptake in Kharif season, so due to adverse weather condition, the higher channel inventory built up. However, it is being consumed. So that is a good trend, I can say. And again here, the growth has mainly come from overall, you may see subdued, but growth has come from newer products. However, the generic products have suffered, so that is where overall growth is subdued.
Sure. Sorry, just a clarification. So on the channel inventory, so Q4 should be a normal quarter?
It's a very good question, but let me also tell you, Q4 is not a major consumption month. Industry usually prepare for Kharif through pre-placement effort. Hence, there is always a limitation on growth purely from the consumption point of view.
Okay, fair enough. That's it from my side. Thank you.
Thank you. Next question is from the line of Sumant Kumar from Motilal Oswal. Please go ahead.
Yeah. So, can you talk about the Akira performance in the Rabi season?
We normally do not talk about specific product performances, But generally, as Prashant indicated, all new products that we have introduced in the last couple of years, they have been very well accepted by the farmers. The growth year on year has also been very good.
Okay. And the second question is, in other expense, is there any forex gain? And freight cost is also lower in this quarter. Why?
Yeah, freight cost is lower basically in this quarter. You are right. And on the forex, there are no major gains coming the other expense.
Okay. And what is the tax rate for FY24-25 guidance?
Sorry, can you repeat, please?
Tax rate. For 24-25.
It's too early to predict for 24-25, my dear friend. We can give guidance, give the same guidance of what we are, because too early. Can we give guidance in the next quarter on 24-25? Will that be okay?
Okay. Thank you so much.
Thank you. Anyone has a question may enter star and one. The next question is from the line of S. Ramesh from Nirmal Bang Equities. Please go ahead.
Hello. Thank you very much. So if you look at your domestic business on the kind of base you have this year, including the weak base in the third quarter, will you be able to do double-digit growth in FY24? What is your expectation, considering the kind of launches you have done this year?
Yeah, so yes, based on the launches we had last 2 years, definitely double-digit growth is what we are expecting.
And would that help you improve your margins as well, given that FY24 should be a more normalized year in terms of at least the inventory overhang, and with the input costs coming down and the freight costs coming down, will that give you some increase in pricing power and margins?
Yeah, so as I said earlier as well, as we start scaling up the new products, definitely margins in new products are better, and definitely it will improve overall margins for sure. And even on the overall, basically ratio also should improve.
Okay. Now on the CSM, when you look at the capex plan, it's about 1,200 crores over 2 years. So how much of this is to increase your capacities and synthesis capabilities for the increase in the order book by about $400 million between first quarter and the second quarter, and how much of it is to build your capabilities to get a normal business as well as to bid for new orders? Please, can you give us some indication of that?
Well, I'm not too sure on several elements of your question, but let me try. So yes, with these investments in last 2 years or even next year including, it will surely add to capacity to the tune of 25 to 28%. And apart from this, as we have been guiding for last few quarters, that we are also working on improving efficiencies of our existing facilities, multi-product plants, and improving throughput. Last year we improved throughput by more than 12-15%. This year also close to 10-12%. So, apart from fresh investments in capacity expansion, we are also improving with technological improvement the plant throughputs of the existing capacities. And all this is certainly helping us get up capacity utilization and also improve capital efficiency, which is also clearly reflecting in the numbers that are there. And this is the whole objective. Being a capital intensive business, our whole objective is to keep improving the capital efficiency.
Yeah, understood. So what I was trying to understand was, in terms of the increase in the order book, is any part of this capex intended to enhance your capacity to be in a position to deliver the increased order book?
Yes. I mean, a part of capacity expansion is certainly towards this increase in order book position, and also some part of this expansion is towards many new products that are also coming through the R&D pipeline and commercialization of those molecules.
Okay, just one housekeeping question. Can you give us some insight into how the other income has gone up and how the interest expense has gone up?
Interest expense, basically you are aware that on ECB there was an increase in the rate, LIBOR as against SOFR. That was one increase was there, and also the exchange rate was also there. Both together has increased the overall interest expenses.
And on the other income?
On the other income, what was the second question?
What is the increase?
Other income is normally pertains to the income from exchange gain will come in the other income.
Maybe you can clarify this on the sidelines.
Yeah, will do that.
Okay.
Thank you. Our next question is from the line of Rohan Gupta from Nuvama. Go ahead.
Yeah, hi sir, good evening and thanks for the opportunity. Congratulations on a good set of numbers. So a couple of questions. First is on, you have mentioned that there has been significant surge in inquiries in non-agri product by roughly 25%. Sir, I understand that right now the revenue contribution from non-agro and non-pharma is still very less. So just wanted to understand when we talk about that continuous increase in inquiries, how well we are leveraged to use these capabilities, use our capabilities in scaling up the revenue from this segment, where you see that over next 2 to 3 years the business can be from non-agri, non-pharma.
Yeah. So basically, these products, if we see non-agri products, they have got a life cycle approach. And right away from the bench to scale up and commercial scale, there is a gestation period, for these molecules to fructify and consume the revenues. So as of now, as a real guidance, there is a good amount of traction happening around, the non-agchem inquiries and the development work taking place. And we foresee that, all this work which is being done will fructify over a period of time in terms of the non-agchem revenue.
But sir, in terms of like 3 to 4 years, where we see this business panning, and will we be using our existing set of plant machineries only for the product development here, or we need to have a fresh capex to capture the growth here?
Yeah, so at commercial scale, broadly the existing type of plant, multi-product plants are being used. Okay, till the time the volumes go up to a scale where you need a dedicated plant. At the development stage, most of the existing setup is what is getting leveraged. But yes, there are certain specific quality-related requirements for such, different specialty chemical areas for which we have already augmented our setups in R&D and further, augmenting them and have plans in FY24.
So further, I still didn't get what is our plan in 3 to 4 years. Any guidance, any target which management has set for
our aspiration, Rohan, our aspiration of getting non-agchem contribution to close to 20% in next 4 or 5 years. This is what we have also guided, that over a period of time, 4 or 5 year time, the contribution of net non-agchem revenues should be to the tune of that percentage.
Okay. So as of now, so the revenue guidance which we are having is still maintaining 20%. I believe that we are still relying on agrochemical product only, and even in agro also, we have that one product contributes significantly to our exports, almost 50% of the volumes coming from the one single product. So do we see that there is a risk in terms of our exports revenues, our CSM revenues, and the 20% growth guidance which you're talking about if we are not able to scale up the other products?
Not really. So I'm not too sure on the percentile you mentioned, but you see there are 3-4 points to keep in mind here. One, that every year we are commercializing 5 to 6 new products. Okay. Today, if you look at our CSM export portfolio, there are 27, 28 products every year, 4 or 5 products getting commercialized. In the last question, we mentioned that 4 or 5 products from non-agchem are already at commercial scale. Next year, we are commercializing 4 or 5 non-agchem products. So you see, with these many numbers of new product launches as well as non-agchem products, the diversified portfolio is already there. So it is no more dependent on one or two molecules. That is one aspect. The second point is that even on the, if you look at the other side, on the domestic side as well, many new products are getting launched. So if you look at the company level, blended level, the diversification is there, in terms of broadening the product portfolio. Even in domestic side, beyond AgChem, we are getting into biological, a large range of products are already in play, and many of them are at the, development stages at different levels. So this is how the product portfolio is getting diversified. So this is certainly not a scenario of dependence on one product per se. But as this model is, obviously, currently we would be dealing with close to say 15, 16 customers, okay, on these 27, 28 products. There are another 35 products, 40 products at R&D scale with addition of another 10, 12 customers. So it's a broad-based structure. Of course, each product will have its own life cycle, and at different points in time, different products will peak. So in next 3, 4, 5 years, the scenario will be completely different.
Thank you, sir. Thanks a lot. Just if I'm allowed, one more question I had. Sir, on pharma side, we have seen that in last 1 year, the profitability of many pharma companies have been impacted, and so as the valuations of these companies has also been impacted. We have been very value cautious, and I think that was also one of the deterrent that we were not able to back some good deal as far as our inorganic growth ambitions are concerned. Do we see that in last 1 year with the moderation and the valuation across the pharma companies, we are now more closer, and the chances have increased significantly that we tap any value deal in the pharma, and we can hear something soon? If you can just give some more idea about that, sir.
Yeah, so we are currently at an advanced stage of negotiations of few of these opportunities, and at an appropriate time, as we materialize the deals, we will certainly let the investors and markets know about it.
Thank you. We'll take our next question from the line of Noel Vaz from Union Asset Management. Please go ahead.
Yes, my question has been answered. Thank you.
Thank you. Our next question is from the line of Naushad Chaudhary from Aditya Birla Mutual Fund. Please go ahead.
Hi, thanks for the opportunity and congrats on a good set of numbers. Firstly, just a follow-up on the previous question on the CSM business. The number of commercials which we did last year and this year seems, looking at the historical run rate, it seems meaningfully higher. So firstly, on the growth guidance, if I look at the commercial numbers versus the growth guidance, do you feel the guidance which we are giving is slightly conservative, looking at the number of launches? And secondly, on this, any of these commercials, can it become a sizable in next 3 to 4 years? Can it become to a similar size of your existing top 2-3 products?
Frankly, it would be helpful if you can please repeat your question.
Okay. So the first piece of question was, in terms of your commercials in the CSM business, last year and this year has been slightly higher than our historical run rate. So going by the numbers of commercial, would it be fair to assume your growth guidance of 20% is slightly conservative?
I'll not say conservative, but yes, this is the guidance. We are very confident, and we always remain, cautious of the global markets, and in any case, we are seeing the kind of upswings which are happening in the global markets, whether it is European markets or American markets and many other things going on. So we have to be mindful of these uncertainties, and keeping those in mind, we always try and give a guideline which we are very confident.
Okay. And secondly on this, from your new product basket, can we see any or few of them can be sizable, similar to our existing top 2-3 products in next 2 to 3 years?
Oh yes, this is the criteria of even deciding on which molecules we are working, be it domestic, be it export. When we decide to work on a molecule for our development for domestic market or for export, we always keep these aspects in mind and screen those molecules on those parameters. And many of these molecules are for multi-products, not for single crop, not for single crop pest segment. So these are for multi-crop pest segments, and therefore they have potential to be a sizable molecule.
Perfect. Thank you so much and all the best.
Thank you. Our next question is from the line of Abhijit Akela from Kotak Securities. Please go ahead.
Thank you for the follow-up, sir. Just to clarify regarding the capex footprint, the asset footprint we have at this point. So we've mentioned in the presentation we have 15 multi-purpose plants. Are there certain dedicated plants also that are part of our infrastructure right now within these 15 or excluding them? And then these 2 new plants that we are talking about over the next 2 years, are these primarily for the newer molecules that are getting commercialized, or is there also some capacity expansion for the existing major products that we have?
Yeah, so out of these 15, there are 3 or 4 dedicated plants that are there, which for which we have long-term contracts and volumes which are pretty high, annual volumes. For the next 2 plants, yes, there are many new products that are getting scheduled there for commercialization. And again, these are all fungible plants, so as the volumes of even existing products grow, we keep switching capacities from one to the other plant in order to meet the customer requirements and all. So that way, these are very fungible plants, fungible assets.
Okay, sir. Thanks for the clarification. All the best.
Thank you.
Thank you. Our next question is from the line of Aditya Jhawar from Investec. Please go ahead.
Yeah, thanks for the opportunity again. Sir, any comment on the inventory situation in our key export markets?
You said inventory position?
Yes. How is the channel inventory in our key export markets?
Well, there is a mixed kind of scenario. It varies from product to product, market to market. So in few markets, yes, there is some sort of inventory pile-up. But in others, we are seeing also scenario where there is challenges on supplying product on time as well. So there is a mixed scenario.
Put in a more better summary. With the uncertainty in China, then definitely the generics are facing the pressure of this build-up at a global level, both of inventories because they were secure and kept. On the other hand, supplies opening up, so that's going to be something which is going to be under pressure in a generic play. Yeah, and that's the indicators, especially in the Latin part of the world, and in certain markets seem to be good. So inventories are a pile up, but yes, there will be certain staggering challenges for some of these areas in the coming year.
Okay. That's helpful. But sir, if you can just specifically talk about how is the inventory situation in North America, South America and Europe?
Well, these are very well captured in global reports. If you see at a general level, yes, there are inventory build-ups, but if the season progress well, they should be aligned. But America and Europe, so the uncertainties of the world have built it up, and I can't say how inventory cycles will run, but this could change depending on what happens in the next 6 months. both from a grammatical point of view and from a logistics and other challenges which could come and swoop over it.
But fortunately, for the kind of products that we are dealing in, we have not yet seen those kind of alarms.
Okay, fair enough. My final question is, sir, typically in agrochemical, patented products. So, as compared to the total ASP of the product, what proportion is the active ingredient?
What do you mean? I didn't get it. In terms of proportion of the active ingredient?
Yeah. So, for example, if the product is selling at say $10, what would be the cost of active ingredient for a patented agrochem?
Well, there is no standard formula, my friend. If you look at the API world, there's no standard formula because cost is very different from the selling price. Selling price is determined by the affordability of the farmer and the value proposition to the farmer and what goes behind technology. So it's not just the cost of raw materials which are driving the cost of sales. There's also investments which companies have made over the last 10, 15 years. And they could be different for different products. They could range from $200 million to $700-800 million. So that is not a cost which comes in cost of goods. So it depends on which lens you look at it. Today, if you're registering one product in one geography, there's a cost. If you're registering multiple crops, different cost. If you're registering different formulations, different cost. And if you're registering a herbicide, there's a different requirement for toxicology requirement. And whereas if you're registering a fungicide, different. So cost of goods has nothing to do with the selling price of the goods, if I was to put that very clearly. Because the other costs which may not be visible on the base of which is driven. But what is looked at, what can the farmer afford, is it creating value to him, and how that can be driven. Yeah? I hope that answers.
Yeah. Thank you. That was very helpful.
Thank you. Our next question is from the line of Nitin Agarwal from DAM Capital. Please go ahead.
Sir, my question is on the pharma business plan that we have. Like in agro, predominantly our entire business is on patented products. In pharma, when we're looking for acquisitions, are we looking for purely patented products, patented CDMO, or are we looking at generic CDMO also?
Well, let me answer both from a perspection and correction. I think when we look at the custom manufacturing business, it is the services which we provide in manufacturing. Products obviously form a part of that. When we look at the domestic business, it's purely products, yes, and crop solutions. When we look at the pharma business, we are obviously eventually the products, but again, we're starting with the service of CRO, CDMO model, feedback put out to you. Yeah? Eventually, they will come into products if you look at manufacturing some of those at large scale. So then you become a product. In your eyes, there'll be a product service of manufacturing.
I get it, Mank, but so we are agnostic to whether it's a generic or a patented product as far as pharma is concerned.
Well, there will be not much of a CRO or CDMO work in generics, but it will be more in the innovators pipe. That's really where we'll be focusing. When we look at CRO and CDMO, it just starts really at the innovator side, where we work with the innovator in the early stage and take it to commercial because of the regulatory frameworks. Yeah? And the generics would be a value and a value add if it makes sense for chemistry synergistic point where we could deliver value. Not from a CRO and CDMO product. Yeah?
Okay. Thank you.
Thank you. Our next question is from the line of Dhruv Muchhal from HDFC Mutual Fund. Please go ahead.
Yes, sir. Thank you so much. So in your 9 months for the export business, you mentioned that the favorable product mix...
Mr. Muchhal, could you speak a bit louder? We can't hear you that well, sir.
Is this better?
Yes, thank you.
Yeah. So, sir, in the exports business, you mentioned that for the 9 months, the product mix and currency is about 12% contribution. So, just wanted to understand what we understand is that in the CSM business or the exports business, the price increase would largely be due to an RM price increase, because that gets passed through is what our understanding is. And if that happens, generally the gross margin should decline because your per kg remains broadly the same because you work on a contribution basis. So, but your gross margins are still improving or still steady. So, just wanted to understand, is there some change in the structure? And also on currency, that also largely is a pass-through, if I'm not wrong, in our contracts. So, does currency, although is benefiting in your revenue, does it also benefit in your EBITDA?
Yeah, so just to explain, first of all, this notion is not correct that there is a per kg margin fixed or something, that is not the kind of business we are in. Yes, we work on a model where there is transparency on raw material costs and conversion cost, and any increase or benefits, they are shared with our partners. Okay. So the price increase, in last 1 year, 1.5 years, there is a significant increase, both in terms of raw material prices and other inputs like fuel and other areas. The benefit that you are seeing here in reflecting in our numbers is, as I explained to the earlier participant also, that it is mainly coming from improved product mix. Okay, if we have been launching, we have commercialized more than 10, 12 products in last 2.5 years. Okay, so product mix is improving. The contribution of some of the existing products, which was different in say last couple of years versus this year. So overall, product mix change is favorable for us. That is one. Secondly, the operating leverage benefit is also kicking in for us. Now, obviously, we were also on the other side of operating leverage maybe a few years back when the capacities were underutilized. But yes, this year those benefits are kicking in for us, and that is what is reflecting in these numbers. So I hope you understand that this is not a one product company and a price is fixed per kg, and therefore you are not appreciating what is reflecting here.
Sir, understood. On EBITDA basis, I understand the operating leverage benefit, but even on the contribution margin, where it is largely the RM, if I'm not wrong, where it's a transparent model, so you get to retain a decent part of it seems the efficiency gains or the benefit from higher volumes.
Yeah, so that comes from product mix, because if you look at the contribution level, I think 1% is the increase in contribution level. So that is kicking in from the favorable product mix.
Correct. So it's primarily the product mix which is helping us maintain our gross margins despite the...
Yes.
Perfect, sir. That makes sense. Thanks, and all the best.
Thank you. Ladies and gentlemen, we take that as the last question. I now hand the floor back to the management for closing comments.
So once again, thank you for joining us on this call, and we look forward to hopefully a successful day, and thanks for all the support to PI. Good evening.
Thank you, members of the management. Ladies and gentlemen, on behalf of PI Industries, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.